Welcome back everyone. In today's video, I'm going to teach you the basics of trading options. Now, I wish I could teach you everything you need to know in a simple 20-minute video, but that just isn't possible. This is a very complicated topic. So I'm going to be making a series of videos, and in this video, the first video, I just want to help you conceptualize and picture in your mind exactly what is happening with a put or a call option. Once you can picture it in your mind, then any other YouTube video that you watch on trading options, it'll be easier for you to follow along and understand exactly what's happening. And an option is just a contract. It's a contract between a buyer and a seller, and you get to choose. If you want to be the buyer, you can be the buyer, or if you want to be the seller, you can be the seller. And what's interesting about these contracts is one person thinks the stock is going up, and the other person thinks the stock is going down. Both people in this contract have to have a contrarian opinion of what the stock is going to do. And these are the definitions that you need to know up front. First one being the premium, which is the amount the buyer pays the seller for the contract, and the strike price, which is the agreed upon price to buy or sell stock in the given contract. There's also the expiration dates, the final date the buyer can exercise the contract if he or she wants. Now, for most companies, most stocks, contracts expire on the third Fridays of the month. There can be weekly contracts or quarterly contracts, but the contracts with the most liquidity or volume of trading is always the third Friday of the month. And a single contract represents 100 shares of stock. So when you talk about a single option contract, just remember it is controlling 100 shares of stock. So for options, there are two kinds. There is the call and the put. And I feel like these names aren't very helpful with picturing what they do. We'll talk about this, but you can either buy or sell. And if you buy a call option, then you're bullish. You think the stock price is going to go up. If you buy a put option, then you're bearish. You think it's going to go down. Inverse for selling. If you sell a call, you're bearish. If you sell a put, then you're bullish. And when you buy a call option, you have the right to buy a stock at a certain price, the strike price, by a certain time, the expiration date. And for this right, you are the one paying the premium. You are paying for this right to the seller. So if you sell a call option, then you have the obligation to sell stock at a certain price, the strike price, by a certain time, the expiration date. And for this obligation, you are being paid a premium. You are going to get paid for selling this call option. And when you buy a put option, it is the exact opposite. You have the right to sell a stock at a certain price, the strike price, by a certain time, the expiration date. And for this right, you are paying a premium to the seller of the put contract. The seller has an obligation to buy the stock at a certain price by a certain time, and for this obligation, they received payment. They received a premium. And for investors or traders, they really do have 6 tools available for them. If your assumption is that a stock will go up, you can either just buy the stock, just buy it, or you can buy a call option, or you can sell a put option. These are all 3 forms of going long. Going long is when you think the stock is going to go up and you're bullish on the stock. Likewise, if your assumption is the stock is going to go down, you can either short sell the stock, borrow it from your broker, sell it, and then when the price goes down, buy it back, return it to your broker, or you can sell a call option or buy a put option. These are 3 ways of going short if you think if you're bearish on the stock price. And the reason why option contracts are so popular, one is to mitigate risk. It can be viewed kind of as an insurance policy if you're uncertain about the future. But probably the more popular reason is it allows you to leverage your money, capital efficiency. Because one contract represents 100 shares of stock, for every $1 the stock price goes up, the contract value goes up $100. And for every $1 the stock price goes down, the contract value goes down $100. In this video, I'm not going to talk about intrinsic or extrinsic value. We're going to do some examples and I'm going to oversimplify them once again in this video. We just want to visualize what's happening. But just know that intrinsic value is the actual price difference between the strike price and the price of the stock. Extrinsic value is the time value and the implied volatility. We'll talk more about this in a later video. So let's try to visualize exactly what's happening with a call option. Here is a price over time chart, time being x-axis, y being price, and the share price of the company is just doing its thing. Stocks go up, stocks go down, and you have an inclination that in the future, the share price of this company is going to go up. You're not 100% certain, but there's a good chance you feel it's going to go up. However, it could go down. You can't be certain. So you decide to buy a 60-day call option, and this is what it looks like. The current stock price on the New York Stock Exchange is $100 a share. You are going to buy a call contract from a seller, and the strike price is 110. So that's the agreed upon price that you would exchange money for stock. And the contract premium is $5. Now that $5 is not what you're paying, it's 5 times 100. It's $5 per share. So you are paying $500 for this, this call option, and you're controlling 100 shares currently at $100. So you're controlling about $10,000 worth of stock. So this is a 60-day call option that's going to expire in 2 months. But let's just try to pretend what would happen if you bought the contract and then you exercised it right away. You would never do this. You would never want to do this. But let's just pretend what would happen if you were to exercise the contract right away when you bought it. Well, you would be paying this other person $110 per share, so $11,000. And you already paid them $500 for the contract. And the current stock for 100 shares is only worth $10,000, so you would lose $1,500. So let's think about exactly what's happening here. If you were to exercise the contract now, while the price on the New York Stock Exchange is $100, you're paying this other person $110 per share for 100 shares. This person would love it if you did that. The reason why is because the person that sold you the contract would love it if you were to pay them $110 for their stock. It's only worth $100 on the New York Stock Exchange, so they're getting way more money from you if you choose to exercise this contract. But what if you were right and the price of the company were to shoot up to $120 per share? Well, you would then exercise the contract at the strike price of $110, so it would cost you $11,000, plus you paid the premium of $500. However, the stock is now worth $12,000. So when you think about what you paid and the premium, your net profit would be $500. Once again, visualizing what's happening here, you're able to buy 100 shares of stock from this person for $110. And on the New York Stock Exchange today, it's worth $120. So this is a really good deal for you, because if you buy it for $110 from this person, if you want, you can just immediately go on the New York Stock Exchange and dump it and then net the profit. But what if you were wrong in your assumption and the share price of the company goes down? It drops all the way to $80 per share. Well, you would choose then not to exercise the contract. What you would be out is just the cost of the contract. Why would you pay $110 per share to this person when you can just go on the New York Stock Exchange now and get it for $80? Your assumption was that it was going to go up and you wanted to get it cheaper from this person, but if you're just committed to buying the stock anyways, just go on the New York Stock Exchange and get it for $80. So when you plot the risk versus reward of buying call options, this is what it looks like. The blue is if you just bought the stock. So if you bought the stock and it was $100 per share and the stock price went to zero, then you would lose $100 per share. And once again, stock price is technically unlimited going in the upwards direction. But when you buy a call option for $5 a share, you're only risking that $5 per share. If the contract expires out of the money and worthless, the only thing you lost was that $5 for the contract price. However, if the price goes up, your profits also are unlimited, minus the cost of the contract, minus the premium you paid for the right to buy that stock. So let's now think about the opposite, and that would be the put option. Once again, company stock XYZ, the stock price could go up, it could go down. However, you've done your research and you've made the assumption that the company stock is going to go down in the near future. Now, you could short sell the stock, and Once again, you take a lot of risk there. So you want to mitigate risk by buying a put option. Now, you're not 100% sure, it could go up, but there's always this duality with the contracts. Could go up, could go down. But you're going to buy a put option contract. And this, the contract details, the current stock price is $100. The strike price is now going to be lower. You're betting that it's going to go down, basically. So the agreed upon strike price is $90. The contract premium per share is $5. So $500 total you're paying for the contract. And you're controlling $10,000 worth of stock. So these are the details of the put option contract. And once again, we're saying it's going to expire in 60 days. Once again, just conceptualizing, visualizing what's happening here. What if you were to exercise the contract immediately? Once again, you would never do this, but if you were to exercise the contract right after buying it, and the share price is currently at 100, a put contract is making somebody else buy stock from you. So if you were to make somebody buy stock for $90 a share, and it's currently worth $100 a share, you're giving somebody $10,000 worth of stock, and they're only paying you $9,000 for it. In addition, you paid them $500 for the contract for the right to do this, so you would lose $1,500. So yes, you would never want to do this. But once again, just thinking about this, for a put option, you have to have the 100 shares of stock in your account. Your broker handles this. If you don't have this, you would do a market order. But think about this. If you're forcing somebody to buy 100 shares, would you rather get $90 when exercising the contract or $100 today on the New York Stock Exchange? You always want the higher price, so you would never do this. Now, let's say that you were way off on your put option prediction and the stock price shot up to $120. And remember, you're the one controlling 100 shares of stock. Would you rather exercise the contract and make this person buy it from you for $90, or would you rather just do a market order on the New York Stock Exchange and get $120? You would not exercise the contract. It would expire worthless, out of the money, because the stock has more value on the free market. But what if you were right and the stock price plummeted to $80 per share? Well, you would then exercise the contract. It would be in the money. And just think about what's happening here. You made a contract with someone saying that they will buy 100 share of stock from you for $90. And on the New York Stock Exchange, the current share price is only $80. So what if you don't actually have 100 shares of stock in your account? How does this get resolved? Well, you just go on the New York Stock Exchange, buy 100 shares from $80, then exercise the contract, make this person buy it from you for $90. You just net profit $10 per share. However, you have to remember that you paid the premium for the rights to have this contract, and that was $500. You made $10 per share, so $1,000 minus $500. Your profit for exercising the contract would be $500. This is what the profit and loss diagram looks like for put option contracts. Once again, this blue line is if you short sell the stock. If you short sell the stock and in the real world the stock price keeps going up, your losses are technically unlimited or undefined. And if you short sell a stock and the stock price goes to zero, you're capped. Your max reward is $100. The stock price went to zero. However, when you buy put option contracts, the most you can lose is the premium for the contract. If it expires worthless out of the money, you lost the premium you paid for the contract. And your upside is just this small little triangle, but your upside is the stock went to zero, and your only cost was the premium for the contract. Okay guys, that was the basics to help you visualize exactly what's happening with call and put options. Let's just use common language. If you were to buy a call option, you are being paid money from the seller, and this is what you would say. You must sell me your 100 shares if I want to buy them from you. And if you bought a put option, once again, you're being paid the premium from the seller, and you would say, you must buy 100 shares from me if I want you to buy them from me, only if it's financially advantageous. Hey guys, obviously in the video I misspoke and I meant to say the buyer pays the seller for the contract. It is the seller who receives the premium from the buyer. And for sellers, they're receiving money from the buyers. And for a call option, I will sell you 100 shares if you want to buy them from me. It's your choice to opt to exercise the contract or not. Same thing with the put option. I will buy 100 shares from you if you want to sell them to me. Okay guys, there you have it. Those are the basics. Once again, I wanted to make this video to help you visualize exactly what's happening with the call and the puts. In the next couple videos I'm making for this series, I will get into the details and I will do real world examples. But for now, I felt like this was a good primer. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel if you haven't already. I talk a lot about finance and investing topics. And if you have any questions or comments, once again, more videos on this topic are coming, but go ahead and leave your comments and questions down below. Until the next video, take care.